put Ajay Bagga joining us in the studios to get us through this evening. Ajay, once again, it's not looking all that great. I mean, we had a few days of some sanity for the Bulls, some hope coming in. But what is your sense and how best to play this volatility?
I think stand on the side, let this pass. Clearly, sentiment is much beyond valuations now, and you can't fight this. So clearly, China was up today, but there was no ripple across Asia. And moment BP declared its numbers, very poor numbers, we saw Europe selling off, and the Indian market last 1 hour we saw. So it's clearly risk-off is very strongly there. As a sentiment in global markets, you can't fight it. So best to stand on the side, let it play out, and then look at entering. Not the time right now to really get into the markets.
You think the low that we made in January can be retested?
I think so. I think it's looking likely. Last time we discussed, I was expecting a Japanese stimulus that came by and that gave us 1 day of recovery. But again, if you see the yen is getting stronger, it's moved up to 120 already. So those are palliative bandages really that are being put on. And with this kind of risk off that's working, we are very coupled into these markets. Second is the correlation of oil and stocks is so high. It's running at 95. You can't really fight this. So moment oil goes down, the global markets follow. There is no rhyme or reason. Oil is more a demand-supply issue. It's really not signaling a recession. We are putting on the commentaries of recession onto it. I don't think it's that strong a correlation. But this happens. It happened about 8-10 years back. It was so in 2009 as well. But this will pass. 2014 even, there was literally no correlation of oil. Going into the global financial crisis in 2008, when Bear Stearns and all were imploding, oil was going at $145. So actually oil is not a good indicator of recessions. I would put my neck out and say that. But right now sentiment is so bad that you have to just stand on the side.
Okay. So clearly global cues are not supportive, and that's a complete given point. That's a point that's well taken. But let's talk about local cues. Do we have reason to worry? I mean, whether you talk about today's RBI policy tone, whether you're talking about the overall earnings setup, do local cues give us any reason to worry?
I think RBI governor has been very consistent. Just on, last week on January 29th at the Deshmukh Memorial Lecture, he gave out most of these and the same sentiment he really put out. And I would read the last paragraph where he said, we will be accommodative. We are looking for the government to bring in structural reforms. He's laid out a full plan for the government. He's talked very nicely about the inflation. And Surbhi, we have to remember that out of the $110 to the $30 that the oil price has corrected, the government has pocketed 75% of that. So if that had been passed on, your CPI would be much lower today than where it is at. So to say that, some economists today were making the prognosis that India, despite commodities crashing, has not been able to, tackle its inflation. So what will happen when oil prices rise? That is wrong. The government has kept 75%, and I support that measure. It's a fiscally prudent measure. It's added a lot of money into the government kitty, and you will meet your fiscal targets because of that. So clearly, I think RBI remains accommodative. RBI remains very firm, very consistent in its message that our biggest issue is inflation. We don't want to engender growth in the short term at the risk of macroeconomic stability. Last week, in fact, he, in details, he brought out the Brazil example that, and then the Indian example of how in 2010-11, when we cut rates, we had a temporary pickup in the economy only to be followed with 3 years of double-digit inflation. So I think RBI governor is very correct in the policy. I see it as positive. Secondly, when he talked about the PSU banks, two messages came out. One, capitalization provisions are enough. This is after RBI has seen the stress test.
Sure.
Second, he says provisions we are not that worried about. I think markets should have taken a cue from that. That got missed.
Yeah.
And third big thing was that we will revalue the assets and allow them for Basel III. Now, there's a lot of real estate sitting in public sector banks. Street news is that a lot of public sector banks have appointed consultants to revalue this real estate, and RBI governor is saying we'll allow that too.
So I mean, the question's on my tip. Then does that mean that banks are a good buy? Well, we're going to take that up after the break. We have to get into a very quick break about earnings. There are hits, there are misses. But are there any numbers that have made you move on a certain stock call or a company call where either you're looking at purchasing something or removing something from your portfolio based on Q3 numbers?
I think IT pharma have been good. And I would look at two-wheelers, I would look at FMCG. So IT pharma, two-wheelers, FMCG, more defensive or a turnaround like in two-wheelers that's coming. And industrials, no. I think industrials got postponed by a year.
Even after the L&T numbers, which a lot of people said perhaps were in line, not too bad.
I think it's still on the ground. There is a lot of trouble. So industrials, commodities, upstream oil, I would stay away.
And this brings me now back to banks because the numbers aren't looking good. If anything, they've been looking scary for the likes of ICICI Bank. We could see more pain next quarter as well. But some of the earlier points that you mentioned, what's your call on bank stocks?
I think it's overdone already. We are discounting in the banks getting totally bankrupt and marginalized. That's not going to happen. I took a lot of cues from the RBI governor's statements today. And if, I mean, he knows the best. If he's saying this after the concurrent audits that we are happy with the amount of capitalization and all the measures he's talking, I think it's overdone. Might be time to look at the banks afresh. I think, as you mentioned also, public sector banks maybe 2 more quarters of pain, but you can start little investments. And private sector banks definitely, especially the retail private sector banks, the housing finance companies, I would start looking at them very carefully.
Okay, all right, Ajay. Good to have you on the show as always. Thank you so much for taking out the time.